Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two must-own tech stocks to consider buying for the long term at deep discounts at the moment. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two really great long-term tech plays to consider at the moment, I'm going to do a quick overview of the market just to give a better sense of what's going on. So there are few signs of hope really on the ceasefire front right at the moment, even as the U.S. and other nations attempt to tighten the screws on Putin and his regime. And despite the ramping up of non-military pressure, the Russian invasion presses forward. Projecting really what will happen next is growing more and more difficult by the day. That said, the market and the world are certainly likely to become increasingly fearful about the possibility of a prolonged or escalating conflict unless a tangible sign of a diplomatic end to the situation comes about soon. And we've seen just the market on a wild swing, not even in just stock prices over the last several weeks, but oil and energy and commodity prices have just gone up and down like crazy. So if we just look at oil, it went from around $90 a barrel as recently as February 25th to $130 last week at one point, and now WTI is back down to around $100 a barrel on Monday. So just a wild swing from 92 to 130 back to 100. We've seen the U.S. Treasury yields do something sort of similar. So we went from about 1.77 in early February to over 2% in mid-February, then back down to 1.73% in early March, and now we're back at 2.1% with the 10-year U.S. Treasury yield hitting its highest level since July of 2019 to start the week. So this has Wall Street essentially pricing in the fact that we will see higher interest rates this week from the Fed. So that's the Fed's next big meeting is March 15th and 16th. So midweek this week, Jay Powell has left the central bank some wiggle room with him saying he was in favor of the 0.25, so the 25 basis point interest rate hike instead of the 50 basis point hike that some have called for. So we'll see midweek, and we'll get some certainly more clarity on that. Obviously, the uncertainty and instability caused by the Russian invasion has really the market being cautious in general, but with that 7.9% inflation reading, it makes it a little bit harder for the central bank to remain super dovish. And outside of rates, we're now in the early part of the first quarter 2022 earnings season, so we'll see more of those reports start to come in with the big banks set to really kick it off later. And then with all this considered, the interest rate picture, especially when we consider that earnings and revenue for the S&P 500 are continuing to grow in 2022 and 2023, should remain really supportive for stocks overall as investors are left chasing returns in the equities market for the foreseeable future, especially if you're trying to outpace inflation that's sitting at near 8% at the moment. The equities market seems to be really one of the only places to do it. So with this in mind, we're going to take a look at two really strong stocks to consider as longer-term plays, and they're both within the broader tech space. And the first stock we're going to look at today is Micron, which trades on the ticker MU. So Micron is one of the largest makers of memory chips in the world. Their various chips are featured within PCs, while some of their chips are also used for storing data, can be found in mobile phones and other devices. The memory space in general has been historically even more cyclical compared to the broader chip market, and it's historically been very heavily impacted by pricing. Luckily, Micron has become less cyclical as it benefits from exposure in areas such as connected vehicles and the all-important data center, which will continue to benefit going forward. Micron's fiscal 2021 sales were up 29%, and its adjusted earnings skyrocketed 115%. And then in late December, Micron posted 33% growth for its first quarter of fiscal 2022. The company also provided upbeat guidance amid the global chip shortage that helped the stock surge after that results. Its CEO also remains confident in its outlook and its ability to grow market share and benefit over the long term through expansion in secular growth areas such as 5G, artificial intelligence, data centers, EVs, and more. So they have exposure to all these huge longer-term growth areas of tech, which is a great sign. With this in mind, looking ahead, the memory chip maker's fiscal 2022 revenue is projected to climb 16% to $32 billion, with 2023 set to surge another 16% higher. And this would come on top of a big year of growth in 2021. And then at the bottom end, its adjusted earnings are projected to soar 48% on top of last year's growth, and then another 23% higher in 2023. In the company's FY 2022 and FY 2023 consensus earnings estimates have trended higher since its last release, and it's consistently topped our EPS estimates every quarter. The bottom line positivity in terms of positive revisions helps it land a Zacks rank number 2 buy at the moment. And Wall Street also remains really high in general on Micron, with 14 of the 17 brokerage recommendations that Zacks has at strong buys at the moment. And Micron's semiconductor memory industry ranks in the top 3% of over 250 Zacks industries at the moment. So that's a great sign. You want to be a part of a stock within a strong industry as well. And Micron lands an overall A VGM score with an A for value and an A for growth, and then a B for momentum in terms of those individual grades. It also has a really strong balance sheet, and it pays a dividend, though the yield sits at just about 0.55% at the moment. In terms of its stock price movement, the stock's up 170% in the last 5 years. This outpaces the broader semiconductor market's 160% climb. And it skyrocketed over 700% in the past decade to crush its chip peers, who have combined average of 440% climb over that to stretch. And this destroys the larger Zacks tech sector's 240% run. So 700 compared to 240 for Micron versus the broader tech sector over the last decade. So that's to give a sense of how strong the stock has been overall. The stock is currently trading nearly 30% below its records at $70 a share right now. This puts it about 55% below its current Zacks consensus price target of $109 per share. So solid upside there as well. And then in terms of valuation, Micron is trading at a discount to the larger chip segment due to memory standing within the space. And then compared to itself, Micron's trading at a 50% discount to its year-long highs and 15% below its median at 7.3 times forward 12-month earnings at the moment. So really solid value, not only compared to the broader chip segment and the broader tech sectors, 22.3, which is pretty standard for Micron, but it's also trading, as I said, a solid discount to its own median and well below its own highs. Is trading against its own highs. It's traded as high as 25 times forward earnings in the last year and a half. So a solid value on that front as well. So longer term, investors want to have exposure to the chip space, might want to consider Micron at the moment. That said, it is set to report its second quarter financial results at the end of March on March 29th. So some might want to wait a little bit longer to see how those results come in, especially with the current economic headwinds still firmly in place. But if you're a longer term investor and you can deal with the possible gyrations the next couple months and maybe even the rest of 2022, might be worth considering Micron at the moment. And the second stock of these two big tech players to consider at a discount is one that's even more well known than Micron and maybe one of the most well known companies in the US and the world, and that is Microsoft. Microsoft is trading under the ticker MSFT. For those of you who don't know, it obviously hasn't needed an introduction really in decades or longer than that. Nonetheless, the technology titan has recalibrated its long-term trajectory in a really impressive way over the last 5 years or so, with its expansion into the booming cloud computing industry and its ability to thrive alongside Amazon and others in cloud has helped it post really impressive growth for a company of its size and age. Its continuing growth within cloud computing will help, as I said, continue to show this growth. We're going to get to that in a bit. And as the space proliferates, it's necessary for pretty much every company and entity and even households really are exposed to the cloud at all times, and they might not even know it. And alongside, obviously, the cloud, it still has Microsoft Office and Windows, which remain really as valuable to many people and companies as ever before. And then on top of that, it has the ability to succeed in the hybrid and remote work world with offerings within that non-email work communication space that compete against Zoom and Salesforce. And then on top of that, we have its Surface space and Xbox and LinkedIn also continue to grow and provide growth in both the top and bottom lines. So if we look at its 2021 revenue growth, it climbed 18% to $168 billion, which came on top of 3 straight years of 14% sales growth. And for 2022, we're calling for another 18% revenue growth. So back-to-back years of 18% revenue growth for a company of its size and age, as we mentioned, is just really impressive. And then we're calling for another 13.5%, 14% growth in 2023 on the top line to get all the way to $225 billion. And these estimates, as we mentioned, highlight the consistency in the expansion within the cloud space, along with its ability to grow all of its other segments as well and make some deals, as we're going to get to in a little bit as well. The cloud computing space is also higher margin. This helps it post 40% adjusted earnings growth last year and is expected to follow this up with another 17% adjusted earnings per share growth in 2022 and 14% stronger in 2023. The company's also consistently beaten our bottom line projections, and its consensus earnings estimates have climbed since its Q2 2022 release in late January, though it does hold a Zacks rank number 3 hold at the moment. The company is also a money printing machine. The last quarter ended with $125 billion in cash and equivalents. The firm returned around $11 billion to shareholders via buybacks and dividends last period, up about 10% from the year ago period, and it raised its dividend payout by 11% in September. The company also approved a new share repurchase program a while ago that further highlighted its financial firepower, and its impressive balance sheet and piles of cash continue to make it and grant it the ability to make both small acquisitions, which it does all the time, that you might not even notice or hear about, and then big acquisitions as well, which brings us to the company's planned purchase of Activision Blizzard. The all-cash deal was announced earlier this year that was valued at about $69 billion on what appears to be a bet on the metaverse and VR gaming. The deal, if it goes through, would be by far Microsoft's largest, and it would bring franchises like Call of Duty and World of Warcraft and Candy Crush into its already Xbox-heavy gaming space. It would also make Microsoft the third largest gaming company just on its own by revenue, behind China's Tencent and Sony Group. So obviously the deal has faced some scrutiny, and it's going to continue to face scrutiny, and it's unclear if or exactly when it will go through at all. That said, just to put in reference how much of a bet Microsoft is making on the possibilities of the metaverse and VR gaming, the planned Activision Blizzard deal is worth $69 billion. The next biggest purchase Microsoft's ever made was for LinkedIn back in 2016, and that was for $28 billion. So just way, way, way bigger bet on the metaverse and VR gaming, which might be a little bit cause of concern for Wall Street, that there could be even more scrutiny on this deal, and who knows, it might not go through. And even if it doesn't, though, Wall Street thinks that Microsoft is a no-brainer. 22 of the 23 brokerage recommendations that Zacks has are strong buys, with the other at a buy. And Microsoft shares have soared 335% in the past 5 years versus the Zacks sector's 75% run. This includes a 140% climb in the last 3 years, and the stock is up about 19% in the past 12 months to extend its significant outperformance of tech, which is actually down 18% during this stretch. Some might be worried they, quote, missed out already on Microsoft stock, but that same attitude would have really prevented you from buying Microsoft at many times in the last 5-10 years. And that's an attitude that can get a lot of investors in trouble if they're worried about, quote unquote, missing out, because people have thought they missed out on Tesla and Apple and all of these big names. But if you're a longer term investor, you don't need to be worried as much about, quote unquote, missing out. And despite its outperformance over the last year, in longer term, Microsoft's actually trading 20% below its November records at the moment at $280 a share, having slipped about 18% so far in 2022. It's now trading around where it was this past July. This also gives it about 30% upside to its current Zacks consensus price target. So even if you're a more near-term investor, there's certainly upside. And if you're a longer-term investor, Microsoft presents tons of upside. And the sell-off has certainly recalibrated its valuation significantly as well. So Microsoft's trading right near its year-long lows at 27.2 times forward 12-month earnings, which roughly matches the tech sector. This has it also near its 5-year median of 26 and puts it well below the 29 times it traded at prior to the initial COVID sell-off. So it's back, having been recalibrated really significantly, trading below where it was in late 2019 and early 2020 before that initial COVID sell-off. So if you're a longer-term investor, you certainly might want to consider Microsoft, and then obviously Micron as well. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.